dividend to the shareholders. So it's kind of a conflicting view. It's kind of a compensating transaction. If you declare more dividend, you retain less. If you declare, if you declare less dividend, you will be able to retain more. So the company, especially the finance manager who has to take a decision relating to how much to retain, how much to declare, is faced with this problem where he has to decide how much of dividend he has to declare and how much he has to retain in the business. This obviously depends upon whether the investment opportunities that are available is profitable or not. Meaning, if the company has profitable ventures, that means if it can take projects which are profitable, then it is better that they retain their earnings, because with the retained earnings, they will be able to invest it in profitable projects, okay, and declare less dividend. So they will retain more and declare less if the company has, if they feel that their investment opportunities are profitable. But if they feel that their investment opportunities are not very profitable, then it is better that they declare dividend, okay, because the shareholders, when they get dividend, they will be able to put it for better use rather than letting the company retain it and use it for investment opportunities which are not very profitable. So it all depends upon whether the investment opportunities available are profitable or not, okay. But what you have to remember is that this is a very, very kind of dicey situation for a finance manager, because the more the dividend that he declares, he helps the board of directors to declare, the shareholders will be happy, but then the company is in a very grave position because it doesn't have enough money for investment opportunities. But if the company, if the finance manager retains enough money for purposes of future, then that means he will not be able to satisfy the shareholders' interest. So when a finance manager needs to take a decision on how much of dividend and how much of retained earnings, he has to be very, very careful so that he does not rub the shoulders in a wrong way of the shareholders, and at the same time he retains enough money to take care of his investment requirements in future. So that's the nature of the dividend decision that has to be taken up by a finance manager. Okay, so now we'll go on to the theoretical aspects of the dividend policy. As I told you, there are two conflicting theories. Okay, now the two conflicting, it's very conflicting in nature, because there is one theory which says that there is absolutely no relationship between the amount of dividend declared and the value of the firm. Now what we mean by the value of the firm is the market value of the firm. So there is one particular school of thought which says that there is absolutely no relationship between the amount of dividend declared and the value of the firm. Okay, so the value of the firm has no relevance with the dividend that is declared, which is what we call as the irrelevance concept, okay, or the irrelevance theory. Now there is another school of thought which totally contradicts the irrelevance concept and says that there is every prominent relationship between the dividend which is declared and the value of the firm. There is a direct relationship between the dividend that is declared and the value of the firm. So which is what we call, for convenience sake, we have divided the two schools of thought into irrelevance concept and the relevance concept. So as I told you, irrelevance concept means that there is no relationship between dividend and the market value of the firm. The relevance concept says that there is a clear-cut relationship, there is a direct relationship between dividend and the market value of the firm. Okay, so first we will concentrate on the irrelevance concept of dividend policy. Okay, now people like Solomon, Modigliani and Miller were the people who propagated this concept of irrelevance dividend theories. Okay, now more so important is the thoughts which have been penned down by Modigliani and Miller. So that's why we call it as the approach or the Modigliani and Miller approach. Okay, so according to Modigliani and Miller, they say that there is absolutely no relationship between dividend and the market value of the firm. Okay, and that the dividend apart, the market value of the firm rests on various other factors where dividend does not feature. Okay, now the basic concept behind the Modigliani and the Miller approach is that now a company, when it declares dividend, okay, part of its profits is being declared as dividend. So what happens is that for the investment requirements, they have retained only very little. Okay, most of their profits, they have declared it in the form of dividend. So which means they have retained very little. So if they have profitable investment opportunities outside, to finance these investment opportunities outside, they will have to go in for a fresh issue of shares. Then what happens is that your earnings being constant, the earnings has to be shared by more number of shareholders. Okay, because what have we done? We have not used the retained earnings. Instead, to finance the investment opportunities, what has been done is you've gone in for a more number of equity issue. That means total number of equity shares that are there in the business is higher than what it was before. So whatever was the earnings which were, let's say, shared by 10,000 shares will have to probably be now shared by 15,000 shares. So obviously the EPS of the shares will come down. How do you calculate EPS? Earnings divided by the number of shares. So when the number of shares increases, obviously the EPS will come down. So when you declare more in the form of dividend, there is less in the form of retained earnings, which means for your investment opportunities, you will have to look outside. That is, you will have to go in for an issue of shares. When you go in for an issue of shares, there are more number of shares in the fold, so which means the earnings per share will come down. When continuously the earnings per share keeps coming down, automatically the market value of the shares will go down. Okay, so what you have gained by an increase in the form of dividend, you will lose by a reduction in the value of earnings or in the market value of shares. Now, let's suppose you don't declare dividend. That means the whole amount that you have in the form of retained earnings is going to be invested in the projects that you have, that you're going to take up. Then in which case, the number of shares is going to remain the same. Okay, so which means the earnings will be shared by the same number of shares, and since you are going in for further investment opportunities without involving more number of shares, your EPS will go on increasing. When the EPS goes on increasing, the market value is also going to increase. So which means when you don't declare dividend, what you have lost out in the form of dividend will be compensated by an increase in the market value of the firm. Okay, so that is what is the concept behind Modigliani and Miller approach. So the conclusion that Modigliani and Miller has arrived at is that now the shareholders, the investors, don't make a differentiation between dividends and capital gains. Now, what do you mean by capital gains? Capital appreciation. What do you mean by capital appreciation? Okay, that's capital gains. That is when you sell the shares and get money. That will lead to, only capital appreciation can lead to capital gains, because capital appreciation means the market value of the firm goes on increasing. When the market value of the firm goes on increasing, if you sell the shares, you will be able to get capital gains. Okay. Now, according to Modigliani-Miller approach, the investors do not make any difference between dividend and capital appreciation through which you are going to get capital gains. They don't make a difference between dividend and capital gains. For them, one and it's all the same. They are just looking at income. Whether it comes in the form of dividend or whether it comes in the form of capital gains is not their problem. Okay, so as long as they get income either by way of dividend or by way of capital gains, it's not a problem for them. Okay, so the investors don't know that much to differentiate between dividends and capital gains. That is the assumption, or that is the understanding of Modigliani-Miller approach. But then the approach of Modigliani-Miller holds good only in a set of certain assumptions. Okay, only based on these assumptions does the approach of Modigliani and Miller stay good. Okay, now let's go into the assumptions a little later. So basically what Modigliani and Miller approach says is that whatever the shareholders get in the form of dividend, they lose by reduction in the market value. Whatever they gain in the form of dividend, they lose in the form of reduction in the market value. Whatever they have lost by not getting dividend will be compensated by an increase in the market value. That is the basic concept of Modigliani and Miller. So using Modigliani and Miller approach, in what way is it helpful to the finance manager is that, as we already discussed, in case the finance manager feels that investment opportunities outside, or when they take up projects from which they will get a return which is better than the cost of capital by getting the shares, then it is better that they invest it in the form of it is better that they retain and declare less dividend. But if they feel that investment opportunities outside are not very profitable, then it is better that they declare, dividend. Okay. So a company where they find that the investment opportunities outside is more profitable should have a DP ratio which is 100%. What do you mean by a DP ratio 100%? What do you mean by DP ratio? Dividend payout ratio. So if they feel that the investment opportunities outside are not profitable, then their DP ratio should be 100%, which means they should distribute everything that they have in the form of dividend and retain 0%. But if they feel that their investment opportunities outside are profitable, then they should go in for a DP ratio which is 0%. That is? What do you mean by DP ratio is 0%? They will have to retain all the profits and declare nothing in the form of dividend. That is the basic concept of Modigliani and Miller approach. Okay, now let's see what are the assumptions of the MM approach, which is nothing but the Modigliani-Miller approach. Okay, now Modigliani-Miller approach, as I said, holds good only under the set of, under the assumptions that Modigliani and Miller has chosen. Okay, now Modigliani and Miller has chosen these assumptions that the capital markets works under perfect competition. Okay, I'm sure all of you are familiar with the concept of perfect competition. So capital markets work under a perfect competition where the investors are rational investors. What do you mean by rational investors? They know what they are doing. Okay, they will not resort to panic selling or panic buying, etc. Okay, because they know what they are doing. They have full information. They have easy accessibility to information. So they know exactly what they are doing and they know exactly what to expect. They are able to evaluate the company's performance in the past and in the future. They are able to know what is the return that they can expect from this particular kind of company. They know all the details regarding the company, so they will take informed investment decisions. So we have a set of rational investors who have full accessibility to all information. Okay, and they've also assumed that there are no flotation and transaction costs also at the time of issue of shares. Okay, and another thing is that they have assumed that either there are no taxes at all or there is no tax differentiation in the taxes on dividends and taxes on capital gains. Okay, but actually this is one of the major criticisms. We'll come to it later, because in practice there's always a difference in the tax on dividends and the tax on capital gains. So since the tax on dividends is usually more than the tax on capital gains, shareholders sometimes prefers to. Can we please have some findings? So shareholders usually prefer to get it in the form of capital gains rather than in the form of dividend, because dividend is susceptible to a higher rate of tax when compared to capital gains. That's how it is in practice. But Modigliani and Miller have assumed that there is no situation of taxes at all, or even if there is a tax, there is no difference between the tax on dividends and tax on capital gains. Both are one and the same. Okay, and the firm has a fixed investment policy, which means the firm decides in advance where they have to invest, how much they have to invest and all that. So their investment policy is fixed, so it doesn't keep fluctuating according to the situations. Okay, and the investment opportunities that have been chosen works under a situation of doesn't work under a situation of risk or uncertainty, which means there's no risk or uncertainty at all in the picture. Okay, these are the assumptions that the MM approach has taken up. Okay, now let's just quickly go through the concept of MM approach with this example. Okay, now as I already told you all, the market value of a share, as we already discussed, that the dividend that you get now will be compensated by less market value in future, or if you don't get any dividend now, it will be compensated by a higher market value later. Okay, now to help us substantiate this, we'll have to take this formula, okay, where P0 represents the current market price, okay, and D1 represents the future dividend. P1 represents the market value at the end of the period, and 1 plus KE. KE represents the cost of equity. 1 plus KE represents the present value of the cost of capital. Okay, now let's just take, for example, you're planning to buy a car. Okay, now let's say, for instance, you've been asked to shell out about 3 lakhs for purchasing the car. On what basis will you decide whether this 3 lakhs is good enough or not? How will you decide? How will you decide whether this 3 lakhs is worth the buy or not? How long will the car? Yeah, obviously. You look into how long the car will serve you. Okay. Yes, the mileage. the petrol consumption, all that, right? So which means you will look at what are all the future benefits that you will get on purchasing the car. If you think that the present value of all future benefits that you will get by purchasing the car is equivalent to the market price of the car today, then you will be willing to pay the market price, okay, today. But if you feel that the future benefits that you're going to get by purchasing the car is not good enough or sufficient enough to match the market price of the car right now, you wouldn't be willing to pay so much because you don't want to pay so much because you know that the benefits it is going to accrue by purchasing the car is not as much as the market price that you have to pay now. So equating that to shares, the current market price of the shares will be decided on the basis of two aspects. One is what are going to be the future dividends plus what is going to be the market price of the share in future. So the current market price of the share will be a reflection of the future benefits. Now future benefits will be of two types. One is the future dividends plus the future market price. Okay, so the present value of the future dividends plus the future market price will be the current market price. So repeating, P0 represents the current market price, which is nothing but the present value of future dividends, which is given by D1 plus P1, which represents the future market price. Okay, so today's market price is represented by tomorrow's dividend plus tomorrow's market price. Okay, the present value of tomorrow's dividend and tomorrow's market price. So from this we can come to this, that is, if you want to find out what will be the future market price, that is P1, this is equal to P0 into 1 plus KE minus D1. Okay, so this is the formula which has been developed by Modigliani Miller, which is what we're going to follow. Next. Okay, now let's just take a small example. Okay, now going by this example to substantiate Modigliani Miller, let's say for instance the present share capital of a company, let's say A Limited, consists of 1000 shares of rupees 100 each. The company is contemplating a dividend of rupees 10 per share for the year. The capitalization rate is 20%. The net income is rupees 25,000. What will be the price of the share at the end of the year if dividend is not declared and if dividend is declared? Apart from that, we are also required to find out how many number of shares will have to be issued if your investment is rupees 48,000, and we are asked to follow the approach. Next slide. Okay, now we are going to use the formula that P1 is equal to P0 into 1 plus KE minus D1. Okay, now let's say take a situation when dividend is not declared or dividend is not paid. Okay, so which means P1 will be equal to P0, which is current market price, which is given to be 100 into 1 plus KE. KE is the cost of equity that is given to be 20%. So that's 0.2. Okay, minus 0. Why minus 0? No dividend. So minus 0, which means your future market price will be rupees 120. Now let's see what happens in case the dividend is declared. When dividend is paid, P1 will be equal to the current market price, which is 100 into 1 plus 0.20, which is the cost of capital, minus 10. Why minus 10? Because you've declared a dividend at the rate of rupees 10 per share. So minus 10, which means your market price will become 110. Now if you notice, if we pay a dividend of rupees 10, your market price is 110. That means your future benefit will be 10 plus 110. By way of dividend, you're going to get 10. By way of capital appreciation, you're going to get 110, which means your total gain will be 120. What happened when dividend was not declared? It will be 0 plus 120. So either way, it's going to be the same. Okay, either way, what happens is, if dividend is not declared, the benefit will be felt in the form of increase in market price. If dividend is declared, there will be two types of benefits. You will get partly in the form of dividend and partly in the form of market price of the share. So, but if you put both together, either way it's going to be the same. That is the major conclusion of Modigliani and Miller. So either case, the benefit that accrues to the shareholder is going to be 120. It's either going to be 0 plus 120 or 10 plus 110. Either way, the total benefit that's going to come to a shareholder is rupees 120. Okay. So that's the conclusion of Modigliani-Miller approach. Okay. Now, using this Modigliani-Miller approach, we can also find out the ideally number of shares that have to be issued, so that we will be able to choose the proper investment proposal. Just go back to the previous slide. Yeah. Can you see there on top? This is a formula which has been derived to find out the number of shares. Okay. So here M represents the number of shares into P1 represents the current market price, which is equal to I represents the investment amount. Okay. Minus X represents the net earnings of the company minus dividend. ND1 represents number of years into the dividend that has been declared. Okay. Now let's say, for instance, in the previous, in the example, just go back. Let's just come to the next one. Next one. Okay. Now if you see M into, now they've asked you to find out what will be the number of shares in case the company declares a dividend. So M is the number of shares which we have to find out, into 110 represents the market price at the end of the period, which is equal to 48,000 represents the investment amount, minus out of your earnings of rupees 25,000, we have declared a dividend of 10,000. How did we get 10,000? The problem said that there were 1,000 shares and on each share rupees 10 was the dividend. Okay, so that means even though you had made a profit of rupees 25,000, we have declared a dividend of rupees 10,000, which means we've retained 15,000. So your investment requirement is 48,000, out of which it can be financed through your retained earnings for rupees 15,000. The remaining, that is 48,000 minus 15,000, you have to get from funds from outside, which means you will have to go in for an issue of shares. Now when you go in for an issue of shares, that means public will have to buy your shares. When they buy the shares, obviously they'll be buying it at the current market price, which is 110. So M into M represents number of shares into 110, which is your current market price, which should be equal to the investment amount 48,000 minus what you were able to retain out of your profits. So we get to know that M is equal to 3,000 shares. That means a company has to issue, this particular company has to issue 3,000 shares so that it can fetch the required 48,000, which means out of the 48,000, they will get 3,000 into 110. That is 33,000 by way of issue of shares, and the remaining 15,000 is from retained earnings. Okay, go on. Okay, now, let's just take another example. Now, D Limited currently has 10 lakh of shares. The current market price per share is rupees 150. Now, the net income of the company is rupees 2 crore and the investment budget is rupees 4 crore. Okay, now, the cost of equity is given to be 12%. Now dividend is to be declared at the rate is rupees 8 per share. Assume approach. Okay. Now you are asked to calculate the market price per share, and when dividend is declared and when dividend is not declared, how many new shares are to be issued on under both the options. Show that the market value of the firm in either case is the same. Just go on. Okay. Now, under both these set of assumptions, that is when you're not going to declare a dividend, you're going to use the same formula, that is P1 is equal to P0 into 1 plus KE minus T1. So first we get taking a situation when dividend is declared. Okay. Now P1 we don't know. 150 is the current market price into 1 plus 0.12 is the cost of capital minus, you're going to declare a dividend of rupees 8 per share. So which means your current market price becomes 160. Now let's say what happens in the other case. That is when you're not going to declare a dividend, it will become P is equal to 150 into 1 plus 0.12 minus 0. Why minus 0? Because no dividend has been declared. So your market price is rupees 168. Now what is the total benefit in this case? First you got a dividend of 8 rupees. Then your market price becomes 160. So total benefit is 168. In that case, you don't get a dividend, but then your market price is 168. So total benefit in that case is also 168. So either case there is no difference. So what does that mean? What does it mean? That is the basic core concept of the MM approach. That there is no relationship between dividend and market price. Okay, so whatever you get in the form of dividend will get compensated by lesser market price. So either way it's going to be the same, that there is no relationship between dividend and the market price. Okay, now using the formula M into P1 is equal to I minus X minus the dividend, we will be able to find out how many number of shares. Okay, now they have an investment requirement for 4 lakhs and their earnings is rupees 2 lakhs, out of which they've declared a dividend of 2 crores. So they've declared a dividend of rupees 80,000. Okay, with the help of this, we are able to find out that the number of shares is 1,75,000. As against this, on the other hand, if you're not going to declare a dividend, M will be equal to 4 crores, which is your investment, minus 2 crores, which is the earnings. Okay, divided by your market price is rupees 168. Okay, so in which case it's been calculated that you need to issue 1,19,048 shares. Okay, now with the help of these information, we need to find out what is the final value of the firm. Okay, now this is a formula to calculate the final value to the firm. Now actually there is a derivation for this, but let's not go into all that. N represents the already existing shares. M represents the number of shares that has been issued now, okay, into P1, which is your current market price, minus I, which represents the investment, plus X, which represents the earnings, divided by 1 plus KE. KE represents the cost of capital. Now using all this, we find that the value of the firm is 16 crores 76 lakh 78,571. Applying it there also you get the value of the firm to be 16 crores 76 lakh 78,571, which goes to show that whether you declare dividend or not, the value of the firm is going to be either way the same. Okay, so that is the this is the proof for the MM hypothesis. Okay, now let's see what are the criticisms against the MM hypothesis. Now when we discussed about the assumptions itself, none of these assumptions seems to be very realistic or practical. Okay, now it is absolutely not possible to have a no tax situation, and definitely in practice the tax on the dividends is more than the tax on the capital gains. Okay, so there can hardly be a situation where there are no taxes, or if at all there are taxes, there will definitely be a difference in the tax on dividends and the tax on capital gains. So that assumption is not a very valid assumption, not a very practical one. Okay, now similarly they've assumed that there are no flotation costs and transaction costs, but in practice there is definitely the existence of flotation costs, and definitely there is the existence of transaction costs. Now what we mean by flotation costs are? What is flotation costs? Yeah, the cost that we have to incur to issue the shares or debentures or to get the loan, etc. Okay. Now transaction costs are when, like for instance, you know, when you're going to buy when you're taking a loan, you will have to pay the, let's say, the brokerage or the underwriter's commission and all that. Okay, that kind of expenses are known as transaction costs. Okay, now it is just not possible to float shares or debentures without flotation costs or transaction costs, which again seems to be a very, very impractical assumption. Okay, and apart from that, they had assumed that there is, the company works under a constant risk, and in fact there's no risk or uncertainty with investment, and there is a constant discount rate. This again is a very very impractical assumption, because the investment opportunities keep fluctuating, so obviously the company cannot follow a fixed investment policy always, and which means the company cannot, always will have to be faced with risk and uncertainty, and they cannot have a single discount factor also. That again keeps changing according to the situation. So these are the criticisms which have been levied against the MM approach. Okay. Okay. So now we will move on to the next theory, which is known as the relevance theory. Okay. Now this theory says that there is a direct relationship, there is a prominent relationship between dividend and the market price. Dividend definitely decides on what is going to be the market value of the share. Okay. Now people who brought in this concept were Gordon, Linter and Walter. Among these, the person who was very vociferously for this concept was Walter. Okay, we have what is known as the Walter's approach to this. Okay, so the others were not so very but they did propagate this concept. So amongst these, what is more important is the Walters approach. Okay, so according to them, the dividend policy of a company has an absolute bearing on the market value of the firm. So dividend definitely decides on the market value of the firm. Okay, now this is because dividends, it's kind of a barometer kind of thing, It's a yardstick on the basis of which shareholders decide to invest in a particular company or not. In fact, it sends a lot of signals to the market. When a company declares dividend, I'm sure you would have noticed, like when a company declares dividend, or if the market gets to know that a company is going to declare dividend, immediately the market prices will shoot up. Okay, now if the company of late has not been declaring enough dividend, definitely the market value of the shares will come down. So the declaration of dividends sends a lot of signals to the market. It gives a lot of stability to the market conditions of the shares, and it gives a lot of hope and it gives a lot of confidence in the minds of the shareholders, because as shareholders nobody wants to wait for capital gains. Like everybody wants today's money. They want to know whether we are going to get the return satisfied. Nobody will want to wait for capital appreciation or capital gains. Okay, so as laypersons, all of us would like to have dividends for the investments that we have made. Okay, so dividends do have a direct relationship with the market price. Okay, so a company, if it wants to survive in the market, if it wants to retain its shareholders, then definitely they have to declare sufficient amount of dividend. If the company does not declare sufficient amount of dividend and they retain all the profits, definitely the shareholders would not stay with them for more than a year. Definitely most of the shareholders will sell off their shares, and if continuously this goes on, then definitely the market value of the shares will come down. Okay, so there is a straight relationship between dividend and the market value of a firm. Okay, now let's come on to Walter's approach. Okay, so as I told you, Walter was the person who very strongly propagated this concept of relevance theory, and he was dead against the Modigliani-Miller approach. Okay, now he has developed a mathematical formula where he has drawn up a relationship between R and K. Now what we mean by R is the rate of return that you get from the investment opportunities, and K represents the cost of capital. So he felt that there is a strong relationship between R and K, that is the rate of return on your investment, and K, which is the cost of capital. Okay, now suppose you have a company where R is greater than K. That means the rate of return on the investment opportunities are more than the cost of capital. Then it is better for such companies to retain their profits and declare less amount of dividend, because when they retain their profits and use it for future proposals or projects, they will be able to get a better benefit. They will be able to pass on a better benefit to the shareholders. So such kind of companies are referred to as growth companies. Okay, now suppose there is a company where R is less than K. That means the return on the investment opportunities is less than the cost of capital. For such a kind of company, it is better that they declare dividend, because if they retain it and use it for investment opportunities, which gives a lesser return when compared to the cost of capital, none of the shareholders are going to be happy. Then later on, you will find that the shareholders start selling away their shares. So it's better to give it off in the form of dividend and let the shareholders decide where they want to invest their money, instead of retaining their money and using it for investment opportunities, which gives you a lesser rate of return. Okay, now suppose R is equal to K. That means your cost of capital is equal to the rate of return from your investment opportunities. It really doesn't matter. Either way, it's going to be the same. Whether you're going to declare dividend or whether you're going to retain it and use it for investment opportunities doesn't make a difference. Okay? Okay. Now, let's see what are the assumptions of the Walters model. Just like our Modigliani-Miller approach had a few assumptions, so does the Walters approach also. Okay. Now, the main assumption that Walters model follows is that the entire financial needs of the company is financed only through internal financing, that is through their retained earnings. They don't go in for outside issue of shares or issue of debentures, etc. If they want money, they use it only through their retained earnings. That is one of the major assumptions. Okay, and another set of assumption is that this concept of R and K, that is the rate of return on your investment opportunities and your cost of capital, are throughout going to be the same. That is, it's going to be constant. Okay, and earnings and dividends on shares are also constant. Okay, so we are going to base this approach on the basis of earnings and dividends per share. This is also in that period taken into consideration will always remain the same. Okay, and it is also assumed that the firm has a very long life. This is something like, in accounts we study about the going concern concept, right? We can have a stable dividend policy only if we assume that the company has a long life. Okay, so these are the assumptions. Now let's go in for the understanding of the Walter's approach. That is a mathematical model that Walter has developed. Okay, now the formula that he has used is P, that is the market price of the share, is equal to D plus R into E minus D divided by KE, the whole thing divided by KE, where P represents the market price, D represents the dividend that has been declared, E represents the EPS, that is the earnings per share, and KE represents the cost of capital. Okay, now let's just take a small example. Let's say, for instance, there are three companies, A Limited, B Limited and C Limited. Okay, now we are asked to calculate the value of equity shares for the above when the DP ratio, that is the dividend payout ratio, is 50%, 75% and 25%. So in this case, that is, if the DP ratio is 50%, they'll declare 50% dividend and retain 50%. If the DP ratio is 75%, that means they will declare 75% as dividend and they will retain 25%. If the DP ratio is 25%, which means they will declare 25% dividend and they will retain 75% under these conditions. Okay, the conditions are for A Limited, B Limited and C Limited. R represents the rate of return on the investment opportunities is 15%, 5% and 10%. Okay, and KE is equal to 10%. KE throughout it's going to be 10%, and the earnings per share is ₹8 throughout. Okay, so the first company, that is A Limited, where R is greater than KE, represents a growth company. Okay, here R is less than KE. Here R is equal to KE. So under these three situations. Okay, so this is the table which gives you the overall picture about this. Okay, now let's say, for instance, we have A Limited, B Limited and C Limited. Okay, and we have first the DP ratio is 50%, DP ratio is 75% and the DP ratio is 25%. Okay, now we using the formula that P is equal to D plus R into E minus D divided by KE, the whole thing divided by KE. Okay, so in the first case, you know that the D is 50% of earnings. Out of your earnings, you're going to declare 50%. The EPS is 8 rupees per share. So which means your dividend is 50% of that, which is ₹4. Okay, so your dividend is ₹4 and R is 0.15 and KE is 0.10 into 8 minus 4. You find the whole thing divided by 0.10, which is KE. You find that the market price per share is ₹100. Okay, now in a similar situation for B Limited, it becomes 4 plus their R is 0.05 because it's 5% divided by 0.10 into 8 minus 4 divided by 0.10. You find that their market price is ₹60. In a similar situation for C Limited, where R is equal to K, you find that their market price is ₹80. Now let's go on to a situation where DP ratio becomes 75%. That means you declare 75% dividend and you are going to retain 25%. So out of 8 rupees, 75% will be the dividend, which works out to ₹6. So you have 6 plus 0.15 divided by 0.1 into 8 minus, I'm sorry, it must be 8 minus 6. It must be 8 minus 6 divided by 0.10, where you get the market price of the share to be ₹90. Okay, so you make a similar calculation, you get your market price to be ₹70 and here you get your market price to be ₹80. Now if the DP ratio is going to be 25%, then in which case 25% of 8 rupees, you're going to declare a dividend of 2 rupees. So it will be 2 plus 0.15. Again here it must be 8 minus 2. Okay, 0.10 divided by 0.10. So you get your market price to be 110. You get your market price to be 50 and rupees 80. Okay. Now the conclusion that we can arrive at it is, now let's take A Limited. When their DP ratio, now what kind of a company is A Limited? It's a growth company because R is greater than K. So for such kind of companies, it's better to retain more and distribute less, because if it retains more and uses it for profitable investment opportunities, it will find that there's going to be an increase in the market value. This is evidence through this. When they have retained 50%, their market price is 100. When they have retained only 25%, their market price dips to 90. When they have retained 75%, we find that their market price soars up to 110. Okay. Now, in this kind of a company, it's reverse because R is less than K. For such kind of companies, it's better to declare it in the form of dividend rather than to retain it. So if you see, when they have retained 50%, their market price is rupees 60. But when they have retained only 25% and they have declared 75, their market price soars up to 70. When they have retained 75% and declared only 25%, their market price dips down to 50. Okay. So for such a kind of company, it's better that they declare more dividend and retain less profits. Okay. But for this company where R is equal to K, it doesn't make a difference either way, whether they have retained more or less, or declared more dividend or paid less dividend. Whatever it is, we find that the market price remains at rupees 80. Okay. So when a finance manager takes his decision regarding how much of dividend has to be declared, he has to look into this kind of a calculation and he has to see under which category do we fall. Do we fall under the growth factor, growth company, or under a decline company, or under an equitable company? So depending upon that, he has to decide how much of dividend to declare and how much of dividend to retain. Got it, girls? Okay. So let's move on. Okay. Now let's see what are the criticisms which have been levied against the Walter model. Okay. I guess nobody keeps quiet, just like you girls. Okay. When there is a model which has been propagated, definitely criticisms have to be levied. Okay. Now, however good it has been, there have been some criticisms, and as we already saw, one of the assumptions is that, first assumption was the company finances its investment opportunities only through retained earnings. But that again a very, very impractical situation, because most of the companies have only little amount to finance through retained earnings. Major part of the investment requirements are satisfied only by issuing equity shares or debentures, etc. So this assumption is not a very practical one. Okay. And they have also assumed that this concept of R, which is the rate of return on the investment opportunities, is constant, which is again not always possible, and the cost of capital has been assumed to be constant. This again is not a very possible situation. So because of these criticisms, Walter's model, there have been some criticisms which have been levied against Walter's model, but all said and done, when compared to Modigliani and Miller approach, Walter's approach is a more practically applicable method. Modigliani and Miller had said that there's no relationship between the two, but in practical sense, we've always seen that there is a relationship between dividend and market value of a firm. So this concept has more relevance in today's world. Okay. So now let's see what is meant by a dividend policy. Okay. Now based on all these theories which have been developed by Modigliani, Miller, Walter, all that. Okay. Now the finance manager has to understand these concepts and decide on what is the quantum of dividend that has to be declared out of the earnings and how much should be retained. That decision regarding how much to declare as dividend and how much to retain is what we call as the dividend policy. Okay. Now, it's always better that a company follows a consistent dividend policy, in the sense that, they follow a kind of a stable dividend policy. Okay. It need not be rigid. It needs to be altered according to the situation, but it's always better to a certain extent, they follow a consistent dividend policy, because each year if you keep doing one thing, then the shareholders will keep getting thoroughly confused, okay, and they won't know whether to retain their shares or to sell off their shares, and in their anxiety there are always chances that they may sell their shares away. Okay, so it's always better to follow a consistent pattern. Okay, now to follow a consistent pattern, we need to understand what are the factors which determine the dividend policy to be framed by a finance manager for a company. Okay. Now these factors can be divided into two parts, that is the external factors and the internal factors. As all of you all are familiar, external factors are those factors which survive outside the company, and internal factors are factors which form a part of the company. Okay, now let's see what are these internal and external factors. Okay, now let's first see what is the external factors. One is the general state of the economy. Now, general state of the economy does decide what is going to be the dividend policy that has to be followed. Now, if the economy in general is doing very well, that means their level of activities is quite high, okay, and I mean, let's say for instance you're in a boom time, okay, then the company may decide not to declare too much of dividend, because why? Remember, we are in a boom period. That means there are a lot of investment opportunities which are available. There are a lot of projects that you can take up because you're in a boom time, which means you need money, which means it's better to retain and declare a lesser amount in the form of dividend. Okay, especially again, in a situation of inflation. Okay, when a company is facing, when the economy is facing a severe inflationary tendencies, that means cash availability may be hampered. So in such a situation, it's better not to declare dividend and rather just retain it in your business. Okay, so that factor also decides. So the business general economy conditions decide on what is going to be the dividend policy. Okay, the next one is the state of the capital markets. Okay, now what we mean by the state of capital markets is your accessibility to capital markets. Okay, the accessibility to the capital markets. This again is a very, very important thing. Now, a company will have easy access to capital markets if it is in a very strong position. That is, if its financial position is very good and if the capital markets as such is very strong. Okay, if the capital markets is strong and if the company is also in a very good financial position, then it will have easy access to capital markets. Then in such a case, the company can declare dividend because it can always get its investment opportunities satisfied or its investment requirements satisfied by going into the capital markets, meaning going in for an issue of shares or debentures. But if the capital market is not doing very well in the country, or if the company is not in a good financial position, then that means they will not have easy access to the capital markets. Then in such a case, it's better that they retain more and give less dividend because they can finance their investment requirements through their retained earnings because they will not be able to get money from the capital markets. Okay, so the state of capital market also decides on what is going to be the dividend policy of a company. Okay, now apart from this, there are a lot of legal restrictions. All of you all are familiar with the fact that companies in India have to follow the Indian Companies Act 1956, which has laid down a lot of restrictions with respect to the amount of dividend that can be declared, which obviously has a bearing on how much a company has to retain. So the company, when decides to declare a dividend, it has to keep in mind all these legal restrictions as given by the Companies Act. Like for instance, a company can declare dividend only out of either current year's profits or past year's accumulated profits, provided they have written off all arrears of depreciation and all arrears of losses have been written off. Okay, and another thing is that when the company is making profits, it cannot declare dividend unless it has transferred a maximum of 10% of their profits to reserves. Okay, so there are some legal restrictions which have to be followed by a company. This is obviously external to a company because it has to go by the Companies Act 1956. Okay, now apart from this, there is also sometimes there are some contractual obligations also that a company has to bear in mind when they're going to declare a dividend. Like for instance, when they've gone in for an issue of debentures. Okay, now the debenture holders may have placed a clause, or when they're going to take up a loan, the banker or the financial institution from whom they've taken up a loan may have placed a clause saying that you cannot declare a dividend of more than, let's say, 15%. Why do you think they're going to give a clause like that? What do they have to do with the declaration of dividend? Yeah, very good. Tell me. Proceed. Very good. To safeguard their rights. Meaning, if the company goes on declaring dividend at a very high rate, okay, which means when you pay dividend, obviously you need, how can you pay dividend? You need to have, of course, profits. When you pay dividend, that is when you're declaring dividend, you have to have enough cash. Okay. Now, if you go on paying high rate of dividend, that means your liquidity position will get affected. Okay. So, when your liquidity position gets affected, the chances that you will be able to pay continuously the interest and the principal repayments to the loan that you have taken or to the debenture holders may be hampered. Okay. So, in the spirit of safeguarding their own interest, the banker or the financial institution may fix a clause saying that you can at no point of time declare a dividend of more than this much. If you're willing to take up this clause, then we will give you a loan. Okay, so in such cases, obviously the quantum of dividend that a company declares will depend upon these contractual obligations. Okay, now the next one is with respect to the tax policy. Okay, now we already saw that in practice, especially in our country, the tax on the dividend is more than the tax on the capital gains. Okay, so in such cases, the shareholders would prefer to wait and get their money in the form of capital gains, wherein they will be paying lesser tax rather than get the dividend. But this need not always hold good. Okay, it depends upon the perceptions of the investors also. And there are some countries where the tax on the dividends is sometimes lesser than the tax on the capital gains. Okay, so in which case accordingly the company will have to decide. So these are some of the external factors. Now let's move on to the internal factors. Okay, now the internal factors is obviously the desire of the shareholders, because ultimately shareholders being the final owners of the company, they are the people for whom you're running the company. So obviously their desire has to be satisfied. So which means it depends on the perceptions of the investors. Some of the investors, can we please have some silent girls? Some of the shareholders may prefer to get their income by way of dividend. Okay, so they don't want to wait for tomorrow and get it in the form of capital appreciation. They would rather prefer to get it in the form of dividend. They are more concerned about today rather than tomorrow. Such kind of customers, you don't have a choice. You will have to pay a good amount of dividend to keep them with you. Okay, now but on the other hand, there may be other shareholders who would like to wait and get it in the form of capital appreciation. So the finance manager not only has to look into the external factors, he has to understand the willingness of the shareholders to wait, or he has to understand the perceptions of the shareholders and then decide on what is going to be the financial policy, dividend policy that he is going to take. Okay. Now apart from this, we have also the concept of financial needs of the company. Okay. Now we've already seen that if a company declares more dividend, then it has less to invest in outside in its investment opportunities. So depending upon the financial needs of the company, the finance manager will have to decide how much of dividend can be declared or how much of money has to be retained. Okay. The next one is the nature of earnings, meaning whether the earnings of a company is stable or unstable. Okay. If it has a stable nature of earnings, meaning in the sense that every year round about the same amount of earnings or the growth factor is constant, then in such cases, then the company can, afford to declare dividend, because they know that whatever they have lost out in the form of dividend today, they can always compensate by getting more earnings in the next year. But if the company has an unstable earning factor or growth factor is not very stable, then for such companies it's better that they retain more and declare less rate of dividend, because don't know what's going to happen next year. So when the company has good profits, it's better that they retain more and pay less amount of dividend so that they can compensate for a dip in the earnings in the next year. So it depends on the stability of the earnings also. Okay. And most important is the liquidity position, because we already saw that to pay dividend you need to have cash. Without cash, obviously you cannot pay dividend. So it all depends upon your liquidity position. If the company's liquidity position is good, then you can pay good dividends. But if you think that the company doesn't have enough cash to pay dividends, then they have no choice but to retain their profits. Okay, so these are some of the internal and external factors which decide on what is going to be the quantum of dividend that is going to be declared or the amount of retained earnings. Okay, now we go on to the next concept, which is what we call as stability of dividends. Okay, now it's always better that the company gets stable the company declares stable dividends. Now what we mean by stable dividends is kind of, the same amount or the same rate of dividend that can be declared. This will deter the shareholders from selling their shares, or they will not resort to panic selling, because they know that same amount of dividend will be declared by the company next year also. Okay, now how do we decide, how do we calculate this stable rate of dividend? One, we have what we call as the constant dividend rate per share. That means, like last year when you must have studied in corporate accounts, you will have, let's say, rupees 2 per share, rupees 3 per share. That means whatever the number of shares, on each share you will be given 2 rupees or 3 rupees, as the case may be. That is known as constant rate per share. Okay. Or sometimes what we can do is we can have a constant percentage. That means, let's say, constant percentage on the earnings, which means 20% of whatever is your earnings may be declared in the form of dividend. Of course, the quantum of dividend in this case will not be the same throughout, but the rate of dividend on the earnings will be the same always. Okay, so the shareholders will have to link the amount of dividend that they've got with the amount of earnings that the company has made. Whatever the company has earned, 20%, let's say for instance, is going to be declared in the form of dividend. So this time if they make 1 crore, then they'll get 20% of 1 crore. Next year if they make 3 crores, then 3 crore, out of 3 crores they'll get 20%. So that is known as a constant percentage. Okay, sometimes what we have is what we call as the stable rupee dividend plus an extra dividend, which means you will pay a certain percentage apart from it depending on the earnings made during the year. If that particular year the company has made good profits, then apart from the constant dividend, they will pay an extra amount of dividend also. Next year if the company is not making good profits, then they will pay only the stable dividend. They will not get the extra dividend. So depending upon the earnings of the company. Now this is, in one way it is a good method, because the shareholders will be assured of a stable rate of dividend, provided the company makes a decent amount of profits. Over and above that, whatever they get is a bonus. Okay, but at least they will be assured, if the company makes a decent amount of profits, at least this much of dividend will always be declared for the shareholders. Okay, apart from that, if the company makes good profit, they will get a higher rate of dividend. That's it. Okay, so that's the third method. So the company can follow any of these three methods to ensure that the company will have a stable dividend policy. Now the question is, why should we have this kind of a stable dividend policy? Okay, now it gives, there are both advantages as well as disadvantages with this. Okay, now the advantages is that when a company declares stable amount of dividend, that means it can, as I told you earlier, it sends the right signals to the market, which means the shareholders will be assured that the company is doing well. They are able to communicate the fact that the company is doing well. That's why they've been giving proper amount of dividends to the shareholders. Okay, so there's nothing to worry at all. The company is doing very, very well. So this will, insist upon the fact that there's no need for the shareholders to sell their shares. Okay, so it would, kind of entice the shareholders to continue with the company, because, it's like, a known devil is better than an unknown angel. Now, this company at least gives you consistent dividend. If you sell off these shares and buy some other company's shares, what is the guarantee that that particular company is going to follow the same pattern? So at least this company is giving us proper amount of dividend. A stable dividend we are able to get. Okay, so that kind of an understanding the shareholders will get. Okay, and all shareholders obviously would want to get a stable income, okay, by way of dividend, because after all they have invested their money, they want to get a return by way of income, and if that return by way of income is stable, they are very, very happy, and this will, as we discussed, sends in the right signals into the market. Okay, so that's the advantage of having a stable dividend policy. Now, what are the disadvantages is that, now just because you want to follow a stable dividend policy, it shouldn't cause a strain on the business activities of the company. Like there are some board of directors who will resort to, unscrupulous methods just to declare dividend. Okay. Now just to see to it that the shareholders will be paid a dividend, if the board of directors resort to window dressing and present a rosy picture so that they will be able to declare dividends to the shareholders, maintain their stable dividend policy, later on it becomes a big problem for the company. Okay, so that means they will end up paying dividend on capital, which is absolutely illegal. Okay, so the finance manager has to decide between the two. Okay, that is what are the advantages and the disadvantages, and decide on it's more of a case to case basis. It depends upon the policy of the company. Okay, so move on. Okay, now let's move on to the different forms of dividend. Now, as all of you all know, generally dividend is paid in the form of cash. Okay, so that we call it cash dividend. Now, sometimes if the company wants to declare dividend, but right now their liquidity position is not too good, then what the company may do is give what is known as bond dividend. Bond dividend meaning they'll give it's kind of a promise that is given. Okay, they give a bond saying that this bond is in lieu of the dividend that has to be declared for the current year, and you can encash this bond after, let's say, 3 or 4 years, or let's say 2 years. Okay, now this is when a company finds that today their liquidity position is not very good, but it will definitely become a little better next year or the next. Okay, so in which case they may give what is known as a bond dividend, where it's a promise that the company will pay dividend, not now, but a little later. Okay, that's what we call as bond dividend. But then considering the conservative nature of Indian mind setup, this is not a very famous method in India. Okay, now the third kind of dividend is what we call as property dividend. Okay, now as the name suggests, what we mean by property dividend is the dividend is not going to be paid in the form of cash, but it's going to be given in the form of some of the assets of the company. Okay, this obviously again is not very famous in our country. It's not much in vogue in our country. Now this happens especially in companies where there are only few major shareholders. Okay, let's say for instance there are only about 10 to 15 major shareholders. Okay, now of course apart from that there may be other shareholders also, but there are only, let's say, 10 to 15 major shareholders. To satisfy these shareholders, the company can distribute a part of its assets, probably some of the assets that they are not using, okay, which is of no use to them right now. Okay, such kind of assets can be given in the form of dividend to the shareholders, which is known as property dividend. Okay, now the fourth method, which is very much in vogue in our country also, is what we call as stock dividend. Can anybody tell me what is the other name for stock dividend? Very good, bonus shares. Okay, dividend which is declared in the form of shares is what we call as stock dividend. Okay, this method is primarily resorted to by the company when it finds that they have profits. Okay, they want to declare that profits in the form of dividend, but they don't have sufficient cash. Okay, so in which case what they do is they simply convert the profits into shares and gives these shares to the shareholders free of cost. Okay, which is why it is called as the bonus shares. Okay, it's given totally free of cost to the shareholders. So the shareholders enjoy the benefit of getting more shares by way of dividend instead of getting cash. Okay, that's what is meant by the bonus shares. Okay, now bonus shares has its own advantages as well as disadvantages. Okay, now the advantages that accrue to a company is that, now the first one is that obviously it conserves its cash position. Why does it conserve its cash position or liquidity position? To declare bonus shares, you don't need cash. What do you need? Profits. Okay, profits should be there. The profits are going to be converted into shares. That's it. It's also referred to as capitalization of profits. It does not need cash. So it can conserve its cash for more, more immediate uses rather than, girls, if you're not interested, that's the door, you can leave. Okay? So it can conserve its cash so that it can use it for other immediate pressing needs rather than to declare dividend. Okay. Now another thing is that when it can keep its EPS, that is its earnings per share, at bay. Okay. Now what we mean by this is, suppose a company is doing very, very well. Okay. So it's been able to multiply its earnings many times. So what happens is that the earnings per share goes on increasing because its earnings goes on increasing divided by the number of shares, so its EPS goes on increasing. So what do you think are the disadvantages of a very high EPS? Can you guess? What do you think are the disadvantages of a very high EPS?
Lot of shareholders tend to buy the shares.
Okay. Yes, the shareholders will start expecting more dividend because they say, that company is making so much earnings. Hello, why can't they give it in the form of dividend, right? Okay, so the expectations of the shareholders will increase. Apart from that, the expectations of the employees will also increase, which means they will start fighting for more bonus or for more pay because they know that, after deducting all their expenses, if the company is making so much of earnings, then that means why can't they give us higher remuneration or higher bonus? So this will lead to all kind of trade union problems and all that. Thirdly, the customers may feel very, defeated or cheated, because after all, how are they able to make more earnings? There are two ways by which a company can make earnings. One, through a very high revenue or by resorting to cost-cutting measures. So if they've made their earnings by resorting to cost-cutting measures, well and good. But if they've resorted to getting more earnings by multiplying their sales price, by increasing their sales price, then the the customers feel that they have been exploited because they are the ones who are going to shell out their hard-earned money to pay so much to acquire this particular company's products, all that. Okay, so on all these grounds, it's always better that a company keeps its EPS at a specific level. Okay, now to enable this, okay, the company is making very good profits. Okay, so that they cannot help. Okay, now, but how do they keep their EPS at bay? How do you calculate EPS? It is earnings divided by the number of shares. So, okay, they are not able to check their earnings and they don't want to check their earnings also. The other one is, other factor is number of shares. So, you just simply increase the number of shares. So, if they increase the number of shares, the EPS will reduce. How can they increase their number of shares? By going in for a bonus issue. So they have profits, if they convert it into shares, the shareholders, in both ways it is beneficial. The shareholders also get something in the form of dividend. The EPS also comes down. Okay, so all problems on all grounds are solved by this method. Okay, the next one is the marketability of the company's shares. Okay, now when the company's EPS has been brought down, okay, by resorting to this method, automatically you will see that the market price of the shares will also come down. Okay, now let's say for instance you take companies like Wipro or Infosys. The market price of such companies' shares are so high, normal middle class people just cannot afford to buy these shares because it's at such a peak today. Okay, so it kind of scares away the investors from investing in such company because the market price is very, very high. So to widen the net of the shareholders, if you're able to bring down the value of the market price, it will help you to widen the network or to have more number of shareholders who earlier would have got scared by the increase in the market price. This is possible if you try to bring down your EPS, which is possible if you go in for an issue of bonus shares. Okay, so these are some of the advantages which accrues to the company as such. Okay, now let's say what are the benefits that accrue to the investors, or in other words the shareholders. The first one is the tax benefit. Okay, now you know that dividend is taxable if it is received in the form of cash. Okay, but dividend which is received in the form of bonus shares, of course that is also taxable, but not to the extent that it is taxable in case of cash dividend. Okay, so it's slightly, definitely lesser than the dividend that has been declared in the that you have received in the form of cash. Okay, so that gives a tax benefit to the shareholders. So because of this, many shareholders prefer to get dividend in the form of bonus shares rather in the form of cash dividend. Okay, the next one is now the fact that a company is going to declare bonus shares, okay, indicates that in future the company is going to make good profits. Okay, that is why they want to declare bonus shares. Now, how do you think these two are linked? How do you think that by issuing bonus shares today, it indicates better profits tomorrow? Yes. If the company feels that they may not be in a position to earn good profits tomorrow, do you think they will sacrifice today's profits by converting into shares? What would they do? They will retain it. They wouldn't want to convert it into shares. So the fact that they have converted their profits into shares shows that they have enough profits. In spite of capitalizing the profits into shares, they're still left with profits, which and the profitability position of the company in the future years is also good. Okay, so that's an indicator that the future position of the company is good. Okay, the fact that company has declared bonus issue will increase the future dividends which are available to the shareholders. Why? Obviously, the number of shares goes up. Let's say, for instance, an equity shareholder was holding 100 shares. Probably now, because of bonus issue, this person will be holding, let's say, 150 shares, which means the dividend, let's say, for instance, dividend is declared at the rate of 1 rupee per share. Then earlier he would have been getting only rupees 100 as dividend, but now he'll be getting 150 without shelling a pie because he did not pay anything to get the bonus shares, right? So without giving out a pie also, he's been able to get more dividend. So that again is a benefit to the shareholders. Okay, and of course it has a very high psychological value. It has a very great impact on the company, because we Indians have this strong feeling anything that comes free is nice to us, right? Okay, so if the company is going to declare free of cost the shares, why not take it? Okay, so it has a high psychological value because it will boost the confidence of the shareholders and it will see to it that the shareholders are very loyal to the company, meaning they will not sell their shares and go away. Okay, so these are the advantages which accrue to both the company as well as to the investors of issuing bonus shares. But the issue of bonus shares is specified by the guidelines which have been followed, which have been issued by the Companies Act in conjunction with SEBI. Okay, there are some basic guidelines which a company has to follow when they are going in for an issue of bonus shares, meaning capitalizing their profits. Okay, some of these guidelines, we glance at these guidelines are, first of all, when a company goes in for an issue of shares, it has to be such an issue of shares in the form of bonus shares has to be certified by the issuer, that is by the company in conjunction with the statutory auditor of the company or the company secretary of that particular company has to give a certificate that saying that they have so much of profits. That is why they are going to declare it in the form of a bonus issue and all that. Okay. Now, apart from that, the issue of bonus shares should not affect it should not dilute the interest of the existing shareholders. And in a more important sense, I'm sure all of you all have heard of FCDs and PCDs. What are FCDs and PCDs? Yes, fully convertible debentures and partly convertible debentures. Okay, now fully convertible debentures are that after a point of time, the debentures will be simply converted into equity shares. Partly convertible debentures is after a point of time, a part of the face value of the debentures will be converted into equity shares. The remaining will continue to exist as debentures. Now, if there is a pending PCD or an FCD, which means in due time, just in another month or so, if there's going to be a fully convertible, when there's going to be a process of fully convertible debentures or partly convertible debentures which is due, a company is not supposed to go in for an issue of bonus shares because this will dilute the interest of the FCDs or the PCDs. Okay, so that's one guideline that has to be kept in mind. Okay, and obviously the declaration of bonus issue should be made only out of revenue natured profits which could have been otherwise used for the purpose of declaring dividend. Okay, this profit earlier could have been used for declaring dividend. Now the same profits are going to be converted into shares. That's it. Okay, so that means you can issue bonus shares only out of free or revenue reserves. Okay, which could have been otherwise used for the purpose of declaring dividend. Okay, now you cannot declare bonus shares in lieu of dividend, meaning in the sense that you can't call it instead of dividend. Okay, now you're giving bonus shares because you don't have cash. You can't say that it is instead of dividend. This is another legal restriction. Okay, now as we already saw, only revenue natured profits can be used, which means any profits which have been derived by the company by revaluation of their assets and liabilities cannot be used for this particular purpose. Okay, and more importantly, the company cannot go in for an issue of bonus shares if it has been found that it has defaulted in the payment of interest on its loans or debentures or the repayment of principal, or in case they have any outstanding statutory dues and all that, then they cannot go in for an issue of bonus shares. Okay, then once the declaration that bonus share has to be issued has been made in the annual general body meeting, then within a period of 6 months, the process of bonus should be complete. Okay, that is, the process of bonus issue must be completed within 6 months from the date of the resolution which has been passed in the annual general body meeting. Okay, now before all this, most important is that for any decision to be implemented, it has to be obviously authorized by the article of association. Okay, now in case your articles of association does not have a clause to this effect, that means your articles of association has not talked anything about issue of bonus shares, then there must be a special resolution which has been passed, and the clause must be inserted in your articles of association, and then only you can go in for a issue of bonus shares. Okay, now apart from this, suppose after issuing bonus shares, your total paid up capital, that means your already existing capital plus the bonus shares exceeds the authorized capital. Can it do that way? Can it be that way? Obviously not. Your paid up capital can never ever exceed your authorized share capital. Suppose, just in case, your already existing share capital plus your bonus shares exceeds the amount of authorized share capital, then you need to pass a special resolution in an annual general body meeting, giving out the fact that such an issue of bonus shares will increase the authorized share capital. So you have to increase the level of the authorized share capital. So you will have to pass a special resolution in an AGM and also get the sanction of the registrar of joint stock companies for doing this. Without doing this, you cannot issue an amount of bonus shares which will be in such a way that the already existing shares plus the bonus shares will go beyond the limit of your authorized share capital. Okay, so these are some of the guidelines that has to be kept in the form of when you're going in for an issue of bonus shares. Okay, so this is chapter on dividend policy. Okay, so thank you girls. Okay, so what we've learned so far is, we've seen what is the meaning of dividend, we've seen what is the nature of a dividend policy, that Damocles sword kind of thing. Okay, and then we saw the two theories, that is the relevance theory and the irrelevance theory. Irrelevance theory has been given by Modigliani and Miller. Relevance theory has been given by Walter. Okay, then we saw what is meant by dividend policy. Okay, what are the factors which determine the dividend policy, and then we saw what are the different forms of dividend: the cash dividend, the property dividend, the stock dividend, and the bond dividend. Then we concentrated out of this on the stock dividend, or in other words the bonus shares. We saw what is meant by a bonus share. We saw what are the advantages that accrue to the company as well as to the investors, and then we saw what are some of the guidelines which has been fixed by SEBI when a company has to go in for a bonus share. Okay girls, have you understood? Yeah, thank you girls. Okay,
and I want to speak briefly about dividend policy. Now, as we know,
okay, just to wrap up this session, I have a small video clipping.
They can pay out those earnings in the form of a dividend, which is typically a cash payment made to investors, where they can retain the earnings, in which case they appear as equity, the retained earnings on the balance sheet of the company. Now, the decision as to what kind of a dividend the company should pay out is one of the decisions that companies have to make in the context of their corporate finance and planning, and in terms of their capital structure planning. There's a theory that was proposed which is known as the Relevance theory, or the capital irrelevance theory, which states that how a company finances itself, i.e. equity or debt, its dividend policy is irrelevant to the firm's value, and given that firms exist to make decisions to maximize value for shareholders and the theory implies that dividend policy is irrelevant as are equity debt financing decisions looking at the same values, right? Now, in order to
for, that would be your holiday work. Okay? Right? Time to enjoy your holidays and maximum 1 or 2 hours per day to spend for it. Okay guys, so tomorrow I will give you all your interview confidence. We have the remaining part of working capital management to be done, that is your inventory management, cash management and receivables management. Okay? Guys, this is a short video only. I'm sure you will get all the examples. Okay?
This is Michael Fisher for savingandinvesting.com, and I want to speak briefly about dividend policy. Now, as we know, companies, when they make earnings, can do two things.